Okay, time for the hot pick segment. We talk a lot about banks in Canada because they make up about a third of the TSX. We also talked about some of the big, broader banks on Wall Street. But what about some of the regionals? That is a sector that Alexander Yokum watches very closely. He's a senior equity research analyst at CFRA, and he has a few regional banking ideas in the U.S. to tell us about today. Great to see you. Thanks for joining us.
Yeah, thanks for having me on.
Let's start with the environment for a regional bank, because I think that right now we've got a changing interest rate environment. We've got all these changes in Washington right now. What does the backdrop for the sector look like, in your opinion?
Yeah, I mean, regional banks has been a tough place to be over the last couple of years, with the collapse of Silicon Valley Bank in California and with rates rising quickly, regional banks did largely underperform. So if you had asked me this over the last few years, I would have said the backdrop was pretty negative. But coming into 2025, things have really turned positive. In terms of deposits, which were a large issue, we've started to see deposit balances stabilize, and most banks are now seeing growth. Loan growth hasn't quite risen yet, but we're definitely expecting improvement in 2025. Fee income should be better in 2025. Net interest income should be better in 2025. And then you mentioned Washington, the regulatory environment should be much better. Over the last few years, it's generally been more and more regulation, sort of stifling loans, banks and loans. And in 2025, we think regulation is going to be more positive. So we think it's a pretty good time to get into regional banks right now.
Okay, and as I mentioned, you've got 3 ideas for our audience today. Let's go through them, starting with PNC Financial. What stands out with that one?
Yeah, so PNC we think is probably our best pick in terms of stability. Again, if you think about from the risk standpoint, when you looked at an event like the collapse of Silicon Valley Bank, which was a significant downturn for many regional banks, PNC actually saw deposit balances rise during that period. So when people were afraid, they went to PNC, which we think is a good sign. PNC is also well managed, so they didn't have any of these significant issues with unrealized securities portfolios, anything like that. And because of that, PNC is in expansion mode right now. So they're diving into those attractive Southeast, Southwest markets, and we're expecting significant growth out of there. What they have found is that as they build branches, their deposits start to rise quicker than the branch increases. So we're expecting the profitability to increase as they build up branches in the Southeast and Southwest. And on the loan side, they've been very cautious with their outlook in this most recent quarter in terms of what they're expecting for 2025, and we would definitely expect them to surpass that. They do have excess capital to really lean into loan growth, and the environment we think will be a lot better. Anecdotally from not just PNC but other bank executives as well, it sounds like business confidence has significantly increased since November, so we're expecting business loan growth to really come back with a vengeance in 2025.
All right. Top pick number 2 is M&T Bank. How come?
Yes. So M&T Bank, we think, is again, they have a very strong capital position. And for them with loan growth, we think it will be strong. And we think M&T's loan growth actually has been better than it looks. When you look at M&T, like I said, loan growth has been a little bit weak, but that's largely because they've been decreasing their commercial real estate exposure. So commercial real estate, sort of has been a headwind for many regional banks, but they've been cutting back there. So they were at 31% of all loans in commercial real estate as recently as 2019. Now they're down to 20, and that is sort of in line with management's targets. So in 2025, we don't think they're going to be reducing commercial real estate anymore. Instead, it'll be growing. And they've actually seen pretty good growth on the business and consumer side, outperforming peers. And now with commercial real estate coming in as well, it should be pretty strong. And on the regulatory front, they're actually opting into the stress test in 2025. So every year, banks, their capital is looked at to see how much capital they need to reserve to keep in case there is a crisis. And a bank of M&T size only has to do that every other year. The larger banks do it every year, M&T every other year, but they opted in this year. And we think that is because they've been reducing commercial real estate, because credit quality has been improving. We think the amount of capital they are required to hold will come down. So then they'll have a lot of excess capital. We think that will lead to a significant dividend increase, significant share repurchases, and like I said, an increase in loan growth. And then if we did have the scenario where interest rates were to drop in 2025, not our base case, but if we did see a significant drop in interest rates, they would outperform on the mortgage side as well. They have about 3 times the exposure to mortgage banking. And in terms of home sales, refinance activity, that type of thing, it's been very weak over the last 2 years. So we think there's definitely pent up demand and, an opportunity for outperformance there.
All right. And your third bank would, correct me if I'm wrong, would be one that has less ties to those trends and more ties to commercial lending. This is East West Bancorp. Tell us about that one.
Yeah, so we really like East West Bancorp. It is a smaller bank, so potentially more risk there, but we haven't actually seen that play out as of late. So they were a bank that underperformed a bit when Silicon Valley Bank collapsed because they are a California-based bank, but sort of like PNC, actually, their deposits really held up well. And today they're actually sitting at record high deposit balances and loan balances, which most regional banks cannot say. And why is this? We think they have probably the best demographic advantage out of all the banks that we cover. And that's because they target Asian Americans. And because of that, a lot of their staff speaks Mandarin. They have a lot of, staff and executives are really plugged into, China specifically. They even have a commercial banking license with China. So their customers are less likely to be lured by other banks. They don't necessarily have to pay up for deposits as much or market as much. And because of that, they're one of the most efficient banks in the country. Now, apart from that, the demographic itself of Asian Americans are growing at roughly 4 times the speed of the U.S. as a whole. So they, again, don't necessarily have to compete as much when their own demographic is increasing. They don't have to necessarily take that from other banks. They are also very well capitalized, and they're quite cautious in terms of their loans. When you look at their commercial real estate portfolio, for example, they have loan to values of about 50%. Most other regional banks are more in the high 50s, low 60s. So that's just to say that if things were to go bad, they're well prepared for that to occur. And then I'll just point out that, over time, they just have a history of out executing. Over the last 25 years, they've actually outperformed the typical bank by about 7% per year. They still have the same management team in place. We would definitely expect that to continue. We're expecting record results across the board for them in 2025.
Alex,